Hello, everyone. Welcome to our weekly live webinars. My name is Dr. Uchenna James, pharmacist and badass stock options trainer. Thank you for joining me today on this beautiful Monday. Oh my gosh, I don't know where you are. Wherever you are, please drop it in the chat. Here I am in Farmington Hills, Michigan, which is a suburb of Detroit, Michigan, and the sun is shining, y'all. So, if you took out some time to be with me tonight, I appreciate you. I am thankful and eternally grateful. So thank you for taking time out on your sunny Tuesday to join me. Normally we do our webinars on Monday, but today we had to pivot because yesterday was my son's birthday and family always comes first. So I decided to pivot and show up for you guys on a Tuesday. And here we are, Thirsty Tuesdays. Can I tell you, the market was bananas today. I don't know if you saw the close, but today we made another all-time high on the SPX. I think the Dow Jones made an all-time high also. I mean, you guys, it's just been crazy. I hope that you're following all of my videos, watching them, and applying them immediately because there's money to be made. Bull, bear, we don't care. Options traders can make money when the market goes up or when the market goes down. So, welcome. We're here today to talk about one of my favorite strategies called bull put spreads. So, thank you for joining me. Today's topic, bull put spreads. I made a mnemonic called the three S's. And let me tell you guys, they are printing money. I have traded over 1,100 bull put spreads in the past like 2 to 3 years. And of course, with the evolution of I was able to collect all that data and produce with you what is working. So if you join today, you're in for a treat. Let's get started. Okay, a few housekeeping rules before we jump right in. Make sure you drop your city in the chat so I can know where you're joining from. Also, questions, drop them in the chat at any time. You don't have to wait for the end. I'm going to be with here from the beginning to the end. So drop your questions in the chat at any time. Grab a notebook. You're going to want to take notes on these three S's. Trust me. And of course, the replay is tomorrow. And also go to my YouTube channel. You can watch the replays there as well. So once again, thank you for joining me. Let's go. So who's teaching tonight? It's me, Dr. Uchenna. Isn't that a lovely picture? Pharmacist first and always. However, over the years, I found that not the W-2 doesn't always pay me what I want to make. So I started learning how to trade stock options over 10 years ago, and I became getting good at it. And my friends were asking me, what are you doing on the meantime? What are you doing there today? What are you doing during COVID? I know you're not working right now. What's going on? And I had to share with them stock options. Stock options is what working for me, and not swinging for the home run, trades. I'm talking about base hits, baby. Every single day I'm in the market. And if you've been in the market this week, wowzers, you have not been disappointed. And of course, if it was bearish or going down, you still, can make money. But when the market's making all-time highs, that means everything is going up. I mean, you could just put on a trade, close your eyes at the end of the day, close the trade, and your account is higher. It's been really easy. I don't know if that's going to last. I'm just telling you how it is now. But the strategy that we're going to discuss tonight is how you can make money based upon time, not necessarily movement. Because if we look at what's going on, and last week we talked about the expected move, the market's like on its 2 times expected move this week. And as you know, sometimes that just doesn't last. I'm not saying it's not going to last this time, but maybe it's time to maybe put on some more higher probability trades that we don't have to sit and salivate as we're watching the market. Today, we're going to discuss bull put spreads. Let's go. What you're going to walk away with tonight, the three things. Number one, the three S's, my whole bull put system in one hook. Support, Sell the 30 delta, set the limit order. You'll remember this forever. Number 2, the watch list that I actually used to trade and the ones, thankfully, that I stopped. Refined, this watch list is refined over the past 3 years. What tickers work and just what don't. Number 3, the 3 hard rules that saved my account. CAHOLD, which is a close above the high of the low day. No earnings within 4 weeks. Stop and make sure I'm placing my stops at every trade. Put your stops in, guys. Let's go. Bull bear, bull bear, bull bear, we don't care, right? That's how I trade. You get paid trading bull puts for being patient. Sell the premium, collect while the stock goes up, sideways, or even slightly down. Come on. Think about that. Stock goes up, I make money. Stays flat, I make money. Even has a little bit of a pullback, I make money. Win, 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 baby. Let's go. Okay. First of all, most successful option traders are spread traders. Like, this is just a fact, okay? And what is a spread? A spread involves the strategies that involve taking opposite positions of a stock, a buy and a sell. One position gains value while the other position loses value. Successful option trading is capturing the probabilities. Spreads create higher probabilities of success. One option is purchased, one is sold. Both are the same type, either calls or puts, and expire at the same expiration. Okay? So this is just some rules that I created for you guys. I only want you to look at the right side of this graphic, okay? We're just going to be talking about credit spreads today. Debit spreads we're going to talk about on another day. So just focus on this side, the right side of this chart. So here we go. Good old-fashioned credit spreads, okay? This is a bullish vertical credit spread. It's called the bull put spread. You buy the lower strike out of the money. You sell the higher strike out of the money. That's the construction. You receive a credit. You receive money for placing this trade. Okay, this is a selling strategy. So remember, when we sell options, time is on our side. Y'all don't want me to sing, trust me. You want the premium to decrease in value so you can buy it back at a cheaper price. That's how you exit the trade with a profit. You make money based upon time. High probability, lowest trade. The driver's the short put, long put is for protection. Okay. So this is a mildly bullish to neutral strategy because remember I said the 3 ways you can make money with this trade is if the stock goes up, the stock stays flat or neutral, or if it goes down slightly. And I'm going to show you what that looks like. So what is the entry rules? Number 1, sell the strike. You expect the stock to be above at expiration. So you want to sell to your target. You want the stock to remain above your short strike or the strike that you sold. Number 2, buy the lower strike depending on the spread risk. So you buy the low strike, sell the higher strike. And what strikes, like what is the width, how many dollars in between the strikes, that's up to you. The wider that spread, the wider those 2 strikes or the spread, the difference between the strike that you bought and the strike that you sold, that's the spread. The wider those are, the more directional your trade is. Okay? Exit rules. Favorable exit, 80% of my premium. Unfavorable exit, 50% loss. But it also depends on how much time I have left in the trade. I'm going to show you what that looks like. Okay. So what am I paying for this? Okay. So as far as the credit spreads, we're just focusing on the credit spreads now. The max loss of the credit spread is the spread minus the credit received. okay? The max gain for the credit spread is the credit that we receive. So if we put on a bull put spread and we receive 50 cents, $50, because it controls 100 shares, $50, the most that we can make on that trade, on that bull put spread, is $50, okay? If it is a $2 wide spread, then the most we can lose is $2 minus the credit received, 50 cents. The most we can lose is a 150. Okay. This is the way it looks. Let's say you have a $50 stock. Okay. So let's say you have a $50 stock. You want to make sure both strikes are out of the money. You would buy like a $40 put. You sell a $45 put. Both of those are out of the money, right? The total credit that you receive is $2. Okay. So I'm going to show you the way that looks on my favorite platform, Thinkorswim. You guys know I love Thinkorswim. Okay. It's the only platform that I'm using right now. And I'm not saying any of the other platforms are not good. Your Tasty Trades, your Robinhoods, your Fidelities, have at it. I am a Thinkorswim trader. That's the platform I use. It is the Bentley's of trading platforms. I hope that you join me on this sweet place. I'm trying to tell you guys, so many people come to me talking about how come I can't read this chart? Because you're using Robinhood or something. Get on Thinkorswim. It pays off. It's free. You have to have a Charles Schwab account, of course. But if you have any questions, just send me an email, drkjtrades@gmail.com. Let's proceed. Okay, so how do we set up this bull put spread? It had you the puts, when the strikes of the put, when it's lower than the stock, those are out of the money. The entire strategy remains out of the money for you to make money. Don't forget, as a seller, you want your option to stay out of the money. That's how you make money. Don't forget those fundamentals, my friend. Okay, so let's say I have a $50 stock. My two strikes that I want to put this trade on are $40 and $45, okay, on the put side. So the debit is $2, the credit is $4, the total credit is $2. So don't forget, this is a selling strategy. Whenever we sell something, we receive money or a credit for it. So the spread is the difference between the two strikes. What's the difference? 45 minus 40, that's $5 spread. What was our credit? $2. So what is our maximum gain? The credit that received is $2. What is our maximum loss? The spread minus the credit. $3 is our maximum loss. Make sure you rewatch this video so you can understand the rules, okay? And how we create this strategy, okay? So, as another recap, what is a bull put spread? It's the strategy that gets you paid for being patient and being right about the floor. So you sell a put at one strike higher and buy a put at a lower strike. Remember, these have to be the same expiration, okay? You collect a credit up front. That credit is yours if the stock stays above your short strike. Every day you're just collecting money. And you're like, excuse me, how do I make sure or like increase the probabilities of the stock staying above my short strike? You gotta look at the charts. You gotta see where the support and resistance levels are on your chart. Because what we're gonna do is we're gonna tuck the bull put under support. Or, remember, as we talked about last week, way under where we think the expected move is going to be. Okay? So the maximum profit that you will get is the credit that you receive. The maximum loss is the width of the spread minus the credit. You win when the stock goes up, you win when the stock goes sideways, and you can win when the stock goes down just a little bit. The key is you don't want the stock to go below the strike that you sold. Once that happens, your bull put spread will lose money. Okay? That's why it's so important that you tuck these bull put spreads under support. You only lose if it crashes through your short strike. Okay? It's a bullish trade. It has a defined risk. How much can I lose? The spread minus the credit. It's a premium seller's dream, guys. I love this strategy. And this little graphic on the right shows you what happens when the stock goes up or down. Okay. You sell a put, plus you buy a lower put, you collect a credit, and you profit as long as the stock stays above your short strike. The maximum profit is the premium that you collected, and you win if the stock stays above your short strike. You lose if the stock crashes below your long strike. It's maximum loss. Okay. If it goes down to zero, you still have that maximum loss of the spread minus the credit. Okay. Bull bear, we don't care. But this is a bullish strategy. You win when the stock stays above the short strike. You win when the stock stays sideways. And you win if the stock just goes down a little bit. How you lose is if the stock goes below your short strike and your long strike. So you lose a little bit if it goes below your short strike. Max loss if it goes below your long strike by expiration. Let's keep going. Okay. You want to know what the trend is. I like doing these stocks on uptrending I like doing these strategies on uptrending stocks. What is that? What is the uptrend? Higher highs and higher lows. Okay. Can you do it when the market goes down and has like a bounce? You could, but I would just pick another stock. Let's increase the probabilities of our trades being successful. Okay. So the 3 S's. This is my whole system. My whole system for bull put spreads are the 3 S's. Number 1, support. Enter on a bounce off of support, higher low or equal low. Number 2, sell at the 30 delta. That means it's a 30% chance that the option will be in the money, which is equal to a 70% chance that the option will stay out of the money. And as a seller, that's what we want. As a seller, we want the options to stay out of the money. That's how we make that moolah. And number 3S, set the limit. You guys, this is the best tip that I've ever given out of all the tips that I've given. Once you enter a trade, you automatically put your exit order ticket in. For bull put spreads, I put my exit ticket in to get me out at an 80% gain. I guarantee you, you're going to, when you start doing this practice, you're going to be collecting so much money and it requires way less management. That is if you have to manually go in and close out at an 80% gain, okay? I always put my order limit to get me out at 80%. And sometimes, when the market gaps up or, gaps down, my order automatically fills at that 80% gain. Please set your limit orders to get you out at 80%, okay? So I told you I've done over 1,100 trades on this strategy over the past couple of years. This is what I use. You can do whatever you want. There's thousands of ticker symbols out there that you can trade on. These are the ones that I use. I like doing bull put spreads on these stocks here. These. These are the ones I do bull put spreads on. These are the ones I don't. And you might look like, why would you not do a bull put spread on the Qs? Because I lose more money on them. That is me. If you want to do a bull put spread on the Qs, do it. Maybe it'll be successful for you. But when I went back and I aggregated all of my data of 1,100 bull put spreads, I'm just going to stick to these because these are my winners. I'm not saying I've never made money, I never made money on a bull put spread on the SPYs. Of course I have. But when I collected all the data, the Qs, the SPYs, and Meta are the ones that just didn't work for me on bull put spreads. These ones did. So those are the ones I trade. I'm not telling you not to. That's just what I do. Okay. NVIDIA, Apple, Microsoft, Google. I put a bull put spread on Google last week. It got filled 80% within 2 days. Microsoft, bull put spread got filled today, right after earnings. I was like, gosh, Microsoft has sold off so much. I want a higher probability trade because I wasn't exactly sure because it gapped up so much after earnings. But Microsoft was like the dog of the darlings all year round. I'm like, I want to put on a bull put so far under where the stock is currently trading at, and Microsoft's premiums are really ripe. So when the implied volatility is high, you get higher premiums. And because it just was through earnings, the implied volatility was higher. So I really got like a good credit. It got filled today. I'm telling you, this strategy is great. Take notes, y'all. So let's see what that looks like. Let's see what that looks like on a chart. I also want to go over the 3 hard rules that saved my account. Okay. I broke these and I paid for them. I want you to learn from my losses so you can save your own account. Okay. Number 1, close above the high of the low day, something I called CAHOLD. I'm going to show you what that looks like. This is non-negotiable. Okay. I do not put on bull put spreads when the candlestick is down. I understand that the puts have been inflated because more people are buying puts when the market is down, so you can get more premium, more credit for your bull put spreads. But in the long run, it was just a losing strategy for me. So I just go with the trend. When the candlestick is up, that's when I put on the bull put spread. Okay. Close above the high of the low day. If today does not close above yesterday's high, wait, I don't play that game. And I have thousands of trades. I just showed you guys what that looks like. So this is just my rule. Every max loss I've ever started taking was when I skipped that close above the high of the low day on a big candle day. I don't do that no more. Number 2, no earnings within 4 weeks. And this, I'm not even going to lie, it's a little negotiable because you don't always have to put your bull put spread for an expiration of 30 days out. You might just want to do like a weekly bull put spread or like a 2 weeks bull put spread or like even a daily bull put spreads on the SPX. You got to get good at that. And you got to sit in front of a computer all day. But if that's how you want to trade, you don't have to use like that earnings rule. But I've noticed that when sometimes if I'm doing like a month out for my expiration, even if I want to get out of the trade earlier than the month, it holds on to the value. The puts hold on to those values because they're expecting a big, move through earnings. That is very, very hard for me to make money and get out of my trade before earnings. And you never know what's going to happen through earnings, right? So just, if you're putting your expiration on those, if you're playing those monthlies 4 weeks out, I wouldn't do it within earnings within 4 weeks, okay? Do not put on a bull put spread if earnings are less than 4 weeks away. If, of course, your expiration date is 4 weeks. If you're doing a weekly expiration, you can kind of, you know, tweak that rule a little bit. Okay. Like I said, it used to be a consideration for me. Now it's a hard rule. It's a hard rule if I'm doing my expiration 4 weeks out. So if earnings falls within my expiration of my bull put, I will not put on that trade. I will sell less time or I'll just look for another stock. Okay. I'm not saying you can't get paid. You can get paid. But number one, if you hold it through earnings, that's a crapshoot. Okay. We all know what's going on right now. It's earnings seasons right now. And a lot of stocks have been beating earnings, like busting right through. I mean, but you saw Apple, that went down. You saw Google, that went down. Microsoft exploded. So you never know what's going to happen after earnings. And we're going to get to the charts in a minute. Okay. Earning surprises are the fastest way to blow up a spread. And I showed you the math. You do not want to take a max loss on this strategy. I forbid you to take a max loss on this strategy. So make sure you check the earnings calendar. And you can always go to Yahoo Earnings to find out when the earnings are. If you're using Thinkorswim, go to the earnings. There's a calendar that shows you earnings on every day, what stocks actually have earnings. Another reason to use Thinkorswim. Okay. Also, set your stop on the platform. I always do 50% loss. Okay. It's kind of hard to set the stop in the platform. If it's confusing for you, just send me an email or just monitor it day by day. And it also determines on how much time you have left in the trade. If for some reason like you put on the bull put spread and then it sells off the next day, you still have 3 weeks, I'm not necessarily going to jump out of my bull put spread that quickly, okay, because I have so much more time. Remember, this is a time-based trade. I make money based upon time. So just kind of like, get the feel for what's going on in the market. If it's in an uptrend, a lot of times when it has like that 1 day pullback, it could be news driven. That's like maybe like a little bleeps, not anything, serious. It should rally back up. Okay. So three out of my trades, 306 out of 1,008 trades of the bull put spread, I had set a stop at entry. Now I usually do for every trade. Okay. If the spread value doubles, means if it's a 50% loss, exit immediately. Of course, always check to see how much time you have left in the trade. Okay. Okay. So your exit plus your risk, this is where your actual money is made. Anyone can enter. Winners exit the right way. Like I said, you never want to take a max loss on these bull put spreads. Trust me, they are painful. So painful. So just do it the right way. So the key points. I usually sell a 30 delta. Okay. But you can do whatever delta you want. If you're selling a delta of 25 to 35, you set your limit at 70 to 80% of your max profit. Let's say you want to get more directional, meaning you want to get more bullish, you can sell a higher delta, like let's say 35 to 50, just set your limit at a 50 to 60%. Set it right at entry. That's number 3. Set your limit order to exit out of your trade immediately. Let's just go see what that looks like, okay? So 3 things to remember. We'll go back to that slide. If you forget everything else I said, the 3 S's. Number 1, support. Sell the 30 delta. Set the limit at 80%. That's the whole system. Number 2, trade the tickers your data says it works. I showed you the watch list that I use. That's what works for moi. And I wouldn't do it on what everybody's talking about. Yeah, people talk, oh, SpaceX, we could do it on a SpaceX. Go ahead, do it on SpaceX. I want to know how it is for you. Share that information with us. So then maybe if it's been working for you consistently, maybe I might put one on like in my paper trading account and see what happens. But I gave you the list of what works for me. Number 3, set your stops in your platform at entry is the difference between a hobby and a business. All right. Show me the money. Make sure you drop your questions in the chat too. Let's go to our option chain. Look at that. This is SpaceX. The reason why I had this on is because they had earnings today. Okay. So like I said, SpaceX went from 125 and now it's trading at like 115. You can't buy options, buy or sell options right now because the market's closed. Remember, the market is open from 9:30 to 4 p.m. Eastern Standard Time. So you actually can't trade options now that the market's closed, but you could definitely buy stock. You could definitely sell stock after market trading. And it's lucrative. It's not as much volume as during the hours of 9:30 to 4 Eastern Standard Time, but you could definitely do it. You just can't do it at options, okay? So one of the ones I like is Apple. So what this looks like to me, okay? All right, now I'm going to show you support levels. So what is support? Support is basically price levels that the sellers don't want the option, or basically the buyers, I would say, the buyers don't want the stock to go below. Okay, so the sellers can sell it down, and then the buyers come in and they say, this is the price that I don't want Apple to get below. And that price is around roughly like between like a 3. Let's see what that exactly that is. Let's not guess. So I have this price level on here. But if you guys ever have questions, you can go right down here to this drawing set and you can add that in. So this price level is like 301. I would just round it and say $300. So I would say a good support right now for Apple is 300. Where would I put my bull put spread? I would put it underneath support. So what I would do, remember, you buy the low, sell the high. So this is what it looks like. I would buy, so 300, I would do the 30 delta. So you go to the trade tab and the market's closed. So we're just going to have to, kind of gauge a little bit and see what that looks like. So the third Friday of the month, remember, is the heavily traded expiration, which is 17 days out. That works within our rules. So what is the 30 delta? 30 delta is roughly 300. So if my support is at 300, I want to get lower than the support. Because right now, Apple's trading at 309. What I could do is I could go further out in time, because in 17 days, it's right at my support. So I could give myself a little bit more wiggle room. I could go 45 days out. So 300 is support. 30 delta, how about we could do the 290, 295, okay? So what do? You buy at the ask, you click at the ask, you hold your control button down, and you click the short strike. So what strike do you want to sell? At the bid. So this is what the order ticket looks like, okay? It's an overall selling strategy. Make sure you're receiving a credit to put on this trade. What is the spread? It's $5 because we bought the 290 strike, we're selling the 295 strike, and then we receive a credit for 130. We have 45 days to stay in this trade. So how much are we going to make on this trade, or what's the max gain? The max gain that we can make on this trade is 130. How much can we lose? The max loss is the spread minus the credit. Your spread was $5, your credit was 130. 5.00 minus 1.3 equals 3.7. Remember, you do not want to take max losses on these trades, okay? So the max gain is 130, the max loss is 370. That's why it's so important that you set these trades up right. As soon as you get into this trade, you got to set it up right. We don't want to be too aggressive where we're going above support. Can you? Yes. Can you make money? Yes. It just increases your probabilities of making money when we put it below support. That's the first S. Put the bull put spread below support. Number 2, sell the 30 delta. You can get the higher the delta that you sell, the more aggressive the trade is. Why? Because now you're getting closer to above 50. Where at the money deltas are 50, anything above 50 is now in the money. As option sellers, you make money when the option stays out of the money. So just keep it out of the money the whole time. Okay? So then you hit confirm and send. There's an order ticket that's saying, is this what you want to do? You want to sell this vertical on Apple expiring September 18th, the 290, 295 put. You're getting a credit for 130, send. Okay. So right now, the market's closed. So it's not going to fill. However, if it fills, it's going to be in your filled orders area. You right click and then you go create opposite order immediately. So how do I get out of this trade at 80%? You take the credit times that 0.2. Okay. So your credit, multiply that by 0.2 equals 0.26. So this is what you would put the order to get you out of. So once this order fills for $1.30, that $130 immediately goes into my account. Then I go to create opposite order. This is the opposite. I put it in for 0.26. Then I change the day to GTC. Once that happens, I confirm and send. So this red order is the order that to get into the bull put spread. Once that is in your filled order, that's when you put the order, the opposite order, to get you out at 80%. So you'll have this credit order in the filled order, and then you'll have this debit order in your working order. That order will stay in your working order until it's filled. When will that be filled? It will be filled closer to expiration. So if Apple continues to go up, then the premium starts to get smaller and smaller and smaller. Once it gets to 26 cents, that's when it's automatically going to fill because you already have the order to get you out of the trade. Okay, so you'll have the $1.30 credit in the filled. Then you go to create opposite order. You right click that and you put the order at 80%, which is 1.3 times 0.2. That's 26 cents. You put that order in, make sure you put in GTC, good to cancel, so it stays in your order, your working orders page until you cancel it. That is how you place this trade. Rinse, repeat. Let's do another one. Just going to cancel these. I also like putting this on NVIDIA. So where is the support for NVIDIA right now? It's actually already drawn on the market, but I'm on the chart, but I'm going to redraw it for you. So right here, look at this. NVIDIA bounced off of this level several times. Here, here, here most recently. okay? So right now, 190 is a good support level for NVIDIA. Also, a good support. Remember, a support is the floor. So the support has to be below where the stock is currently trading. So if we look at this 190 level over here, like around January, February, this 190 was acting as resistance, the ceiling. It was just a number that NVIDIA had a really hard time getting above. Okay. And then now, more recently, it became a floor. So that happens often. Resistance can turn into support. So resistant is the levels that the stock have a hard time getting above. That's when the sellers come in. The buyers are like, buy, 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 buy. The seller comes in and like, no way, forget it. And they sell it off. They keep selling at that level. So over here, the sellers are more in control. Over here, the buyers are more in control. Do we see that? And so right now, NVIDIA is at a resistance level. It came like it bounced off of this level several times. So this level here, around the 213-ish level, look at that. It bounced off on this date. So I'm just going to circle these for you. Right around here, 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 here. So this 213 is a strong resistance level right now. NVIDIA closed today at 211.94. Look at this. After hours, NVIDIA is above that resistance level. Of course, the market's closed right now. We can't put this strategy on, but this is considered, if NVIDIA continues to climb, it's considered like a breakout above this resistance. So is this the best time to put on a bull put spread on NVIDIA? Not really. Why? Because it's a way above our support. Like if we were going to put on a bull put spread on NVIDIA, we would want to do it like right here. Okay. Also, you got to watch out for earnings. Earnings on NVIDIA are, what date is this? August 25th. So if we were to put a bull put spread on like July 31st for like a week or two, even a month, it would be making some good money right about now. Okay. So make sure you're looking for those support levels. We're going to sell the 30 delta. And once it fills, we're going to automatically put an order to get us out at 80%. Let's look at another one. What's another one that we like to trade? I love Google. I mean, I really I just do. Let's look at the charts. This was so great last week. So last week, Google had earnings, right? It was on July 22nd. It sold off to like right here, like 317. And once it did this, I was listening to the earnings conference call, and it was like really not that bad. It was like Google was spending a lot of money, but they're so profitable. Through the earnings call, I found out this information. And I know that stocks notoriously, pro tip, they like to fill in gaps. So when Google sold off like this, and the overall market was bullish, I put on a bull put spread on July 28th. It got filled as soon as this gap happened on July 31st at 80%. Okay. So once I saw that this bounce was strong on higher volume, that's when I put on that bull put spread. Okay. Microsoft. When Microsoft had earnings here, this was July 30th, it gapped up, right? But then when it closed above the high of the low day, I said, you know what? Microsoft has been spanked so bad, I'm just going to put on a bull put spread. Put it on this date. It got 80% filled today. Okay. And Microsoft, I mean, right now, Microsoft is kind of like, well, like it's kind of like at resistance right now from all the way back here. But the PE is like so low. I think Microsoft is just going to keep going up. I mean, this is a chart of the 1 year, 1 day. If you look at, we could look at the 2 year, 1 day. So Microsoft's previous high was 555 on July 31st, actually last year, right? And then got down to a low of 351. Like, that's pretty bad for a stock that is so profitable, like Microsoft, like our blue chip stocks. So that $200 move from a year ago, I mean, look at all the sellers. So now that's why it had such a big gap, because they sold it down so much. And then it went from 389 to today it closed at 492. That's why the bull put spread was such a good strategy at that time. Okay. Let's do one more. We can do like, I really don't like Tesla. We could look at SPX. I mean, this is just ripe for bull put spread seasons. But for SPX, I usually do like 1 day or like 1 week trades, and it's paying, guys. I would be a little cautious because it made such a big move so quick. But SPX, especially if you're paper trading, you could really get a lot of trades in and collect that data. Just if you're doing dailies, just go to a smaller time frame. Like if you're looking for like a weekly trade on the SPX, use your 30-minute chart. Like, and if you're day trading, I would definitely use like the 2 minute, I would use the 5 minute and the 2 minute chart. Okay. So that's how you want to, if you're, so the smaller the time frame for your expiration, the smaller chart time frame you use for your charts to collect that data to do your technical analysis. Okay. Okay. Any questions? And don't forget, I have my course, the 4-week stock options mastery training for $497. Read option chain like a pro. And of course, if you want me in your corner for 12 weeks, I got my 12-week private coaching program, $4,997. I mean, it's the best money you're going to spend, guys. All righty. And next, we're going to resume our weekly webinars next Monday at 7 p.m. Don't forget the 3 S's, okay? You want to put your bull put spreads underneath support. Sell a 30 delta, set your limit to get you out at 80%. Thank you. I appreciate every minute you gave me this evening. Bull, bear, we don't care. Options traders make money when the market goes up or when the market goes down. I'll see you next week.